So let's talk about economics and the investment markets. This is a reading that has very little in the way of quantitative stuff, but lots of intuition overlay. So if you really liked your economics classes in high school or college or wherever you took them, then you'll find this to be pretty straightforward. But there's a few basic principles that you got to get a hold of early on, and then the intuition for the rest of it sort of follows from those original intuitive insights. So let's make sure that we understand what's going on with the first few concepts, and I think you'll find that it gets a little repetitive, but repetitiveness is good because it allows you to extend your intuition and makes the studying for the exam a little bit easier. So, and when we're talking about valuation, and again, still we're thinking of this in terms of equity markets primarily, but we're also going to spend a lot of time thinking about interest rates in this particular reading. Well, the most idiomatic statement of the CFA curriculum is this first bullet point. Okay, the value of any asset is the present value of the estimated future cash flows. So we talk about that as the basic model when we were doing equity at all three levels. So if you want to understand the value of an asset, you estimate its future cash flows, you discount those back at a required rate of return, that is the value of the asset. And you do that whether you're doing some sort of DCF, if you're doing relative valuation, all of it essentially relies on this, and the factors that affect it are certainly what drive valuation. So we can think of the discount rate, that is cash flows over the discount rate, as including a risk-free rate, expected inflation, and risk premiums as applicable. It is this as applicable that we're going to spend some time thinking about, where those come in and what they look like, and how they may, how they're going to be sensitive to economic cycles and those types of things. So changes in value. So if we're looking at the value of an asset, okay, it's $16. Why does the value of that change? Well, it's got to be due to either the numerator or the denominator, right? It's going to be either a change in the cash flows. So maybe there's some reason to expect cash flows to future cash flows to increase. New patent, big new contract, increase in the perceived innovation of the firm, whatever it happens to be. Same thing could happen with a decrease. You could get sued, those types of things. Or one of the discount rate elements has to be impacted. That is the risk-free rate, the underlying cost of moving consumption through time in the economy, the amount of inflation that we have, the risk premiums that would be relevant to this particular asset. One of those elements can change, and that would change value. Now, we're talking again about changes here. So it's changes in cash flows or changes in these elements of the discount rate that are going to be important in terms of changing values, because existing expectations, they're already going to be built in to whatever the price is. So when any of those change, we would expect to see value change. And I think in order to do well on the CFA exams, especially at level 2, you have to internalize this thinking that the value of any asset is the discounted value of its future cash flows, because everything we do comes back to that in one way or another. Now, let's talk about real short-term interest rates. So real means that we're not considering inflation. We're looking at the cost of moving consumption through time, and we think of that as intertemporal. So intertemporal means through time. The intertemporal rate of substitution, we're substituting consumption today for consumption tomorrow. And we call that M sub t. It's the marginal rate of the intertemporal rate of substitution. And we're going to do this based on marginal utilities. Now, if it's been a while since you've taken an economics class, remember utility just means happiness, right? So the more utility you have, the better off you are, the happier you are, that type of thing. And it's really important to remember that we're looking at this in terms of marginal analysis. So what we have in the numerator here is the marginal utility of consuming 1 unit in the future. So let's think a year from now, and there's no real time frame that necessarily needs to be associated with this other than current and future. But if you think a year from now, at the margin, consuming 1 more or 1 less unit of whatever it is you consume. So I really love Dr. Pepper. Cheers. I have some happiness or some utility I get from consuming that. Well, if I could consume 1 more unit of that a year from now, how much happiness do I get from that versus the marginal utility that I get from consuming it now? All right? So a couple of things that are going to characterize the economic or rational man or rational person in this paradigm is, one, we're non-satiated, so we always want more. It's one of the dismal things about economics. And we also want it sooner. So we're going to start from the assumption that the utility that we get today is always going to be greater than the utility that we would get in the future. All right? So let's think for just a moment about this marginal rate of substitution, right? So it's the utility that we would get at time 1 over the utility we would get at time 0 today. And remember, this is the marginal utility of consuming one more or one less unit. And I'm not going to put an equal sign here because I want to change things, but let's just, as kind of a base number, say that the utils we would get from consuming something today, whatever it is we're talking about, would be 10. And the amount of enjoyment or happiness we would get from consuming it a year from now would be 8. That would give us a marginal rate of substitution equal to 0.8, right? So if we wanted to think, and I'm going to hold the denominator constant because I know how to divide by 10. But what sort of events would happen in our lives or in the economy more generally as related to this article that would make this numerator, okay, the value of consuming in the future, be higher so that the marginal rate of substitution here would be 0.9. So when would that change from 0.8 to 0.9? Well, you can think of it this way. Suppose that the economy is growing really fast, or I've started a business and it's growing really fast, or for whatever reason, I think I'm going to have lots of consumption next year. Well, if I think I'm going to have lots of consumption next year, then one more unit of consumption next year is not going to be particularly valuable to me, right? So if we're thinking of, what's going to change this from 0.8 to 0.9, if I think that things are going to be really good in the future, we're going to have good states of the world, well, then this marginal rate of substitution, this would be something like a good state of I'm predicting a good state of the world, so I'll put an expectation sign in front of it. I'm expecting good things in the world, well, then that one more unit is going to be less valuable to me. But on the other hand, if I were expecting bad things in the world, well, then the ability to consume one more unit in the future might seem really valuable to me today relative to the value of consuming today, right? So the rate at which we're going to trade off consumption today, I can either consume it today or I can consume it in the future, okay? Well, that is going to be determined, at least in part, by how we view what's going to happen in some state of the world in the future, whether things be good or bad, as well as other things that can occur. And remember, we've abstracted from inflation and those types of things, and we're going to add all that in later. But we have to think about what's going to change this number. Now, whether we could also say we have changes in the denominator if we really wanted to think about it. But going from a low marginal rate of substitution of 0.8 to a higher marginal rate of substitution of 0.9, well, that's going to be something that we're going to need to think through, especially through these first few slides, all right? So you can think, someone in college, well, they're, a starving student. Consuming today looks really valuable compared to consuming in the future. So they would have a really low rate of low marginal rate of substitution. If you look at somebody that's close to retirement, maybe somebody who's underfunded and close to retirement, well, being able to consume in 5 years in retirement may look really valuable to them. So that would be something where, they're trying to stave off starvation after they got too old to work or something like that. So we can think about, our forecast of income, our forecast of the state of the economy. All those things are going to impact this M, that is the marginal rate of substitution. So we're going to start from the supposition that M is less than 1. And what we can do then is relate this to interest rates. Of course, this marginal rate of substitution is going to drive interest rates. So how much we save is going to be dependent on this, those types of things. So if we look at the price today of a 0 coupon, $1 par value, inflation indexed bond. Okay, now this inflation indexed bond, that just means that we're not worried about inflation yet. We're just trying to get that out of the equation because we're just talking about the real rate at this point. So we're also going to use a risk-free bond because we're not worried about risk premiums yet. We're going to get there, all right? But right now, this is just something where there's zero inflation and zero risk, or at least we don't have to worry about it. It's risk-free and inflation indexed. Well, the price of that bond today is going to be equal to our marginal rate of substitution. So if it's going to mature in one period, and it's going to mature for $1, well, then how much are we going to, what is it going to be worth today? Well, if it's worth, 0.9, so it's worth 90 cents today, so I can put a dollar sign there, well, that 90 cents is our marginal rate of substitution. So we can link that, it is the price of the bond in this model, okay, and we can also link it to interest rates here. Remember that, this is, don't be confused by the formula. This is nothing but P1 minus P0 divided by P0. But remember, the par value of the bond is $1, so this is just holding period return, right? Well, that's got to be equal to 1 over our marginal rate of substitution minus 1. So if we think, well, all right, if our marginal rate of substitution is 0.9, so the bond is trading at 90 cents per dollar, well, then we take, 1 over 0.9. And that's minus 1, and that's going to be equal to, I guess, 1.11 minus 1. So we get an interest rate equal to 11%, right? So we can take the holding period return, calculate it based on prices, okay, but we can also infer marginal rates of substitution by looking at this same calculation. All right? So due to diminishing marginal utility, the more I have to consume in the future, utility of consumption is higher during periods of scarcity. So if things are scarce today, right? Example about college students. Well, today they're struggling students, or however we want to term it. Well, then consumption today is really valuable relative to consumption in the future, because they're thinking, hey, I'm going to get out of here and I'm going to get a big job with Goldman Sachs and I'm going to make millions of dollars. So, one more unit of consumption in the future, one more can of Dr. Pepper 5 years from now is going to be worth very little in terms of marginal happiness to me at that point. All right? So real short-term interest rates, the marginal rate of substitution, and this working back into interest rates. I think that if you don't understand this, there's a lot of these interest rate concepts that are going to be difficult. So I think we've already talked about everything on the slide, but as a quick review, so if investors expect higher incomes in the future, that's my college students example, utility of consumption in the future relative to current consumption is going to be low and the real rates are going to be high. So, if the denominator was 10, well, to a student, the numerator might be 3, right? So this would equal 0.3. Well, then interest rates implied were 1 over 0.3, and I don't know what that's going to equal, but it's going to equal a lot, right? So anyway, so the point here is if you expect to have much higher income in the future, you're going to be, it's going to take a really high interest rate to induce you to save. Right? So because you really value current consumption relative to future consumption. So the savings rates are going to be dictated by the expected return. So if savings rates go really, really high, well, then people even that value current consumption will, cut back on current consumption in order to save. Or when uncertainty about future income increases. So if our future income is less certain, well, we'll save more. So think about someone who's working in a challenging industry, that's not the right word, a troubled industry. So if you look around the industry and you see the competing firms laying people off, and there's rumors of layoffs at your plant, you had 3 layoffs last year, well, your income in the future is going to be less certain. Well, those people tend to save more today than they did 5 years ago when everyone was 10 feet tall, bulletproof, and invisible. So anyway, so if we have high rates, okay, if we have the expectation of higher income or uncertainty about our income in the future, then we will tend to save more. All right, long-dated bonds. Okay, so here, and this again, I think it's important to get on top of this concept, the marginal rate of substitution, and what we're going to do here in terms of introducing the long-dated bonds and the risk premium are sort of the foundation for the rest of this reading. So if you get these first few slides down, I think you'll see that the rest of this is pretty smooth. Okay, so what we mean here, or what we're looking at, is again a risk-free, inflation-indexed, zero-coupon bond with a long-dated maturity. And long-dated maturity here simply means that we're standing here today. We're going to evaluate the return over the next period, and the maturity of the bond is farther into the future. So we don't know what the value of the bond is going to be at time 1. So we're standing here, today at time 0. Here's time 1 when we're assessing value. So we're going to have the price at time 1, and then it's going to mature somewhere over here, time M. But that's well past whatever the time period we're talking about. So what is the price of the bond today? All right. So the price of the bond today is going to be its expected price in the future divided by 1 plus this capital R, and here you can think of this as the real interest rate, okay, or the real rate of intertemporal substitution. Okay, but we also have this thing, the covariance between the price of the bond at time 1 and the marginal rate of substitution at time 1. Okay, and here's the idea. What we're doing, this is essentially, well, I guess the covariance thing has some economic intuition behind it, but essentially this is a modeling trick to introduce a risk premium, right? So this covariance between the price of the bond at time 1 and the marginal rate of substitution at time 1 is captured by the covariance, okay, and is intended to look like or talk like a risk premium. So we're going to say, well, the price of the bond, and so it's going to act like a risk premium because it's going to be negative. Okay? We're assuming there's a negative covariance here. So the way you can think of this is, look, we know the price of the bond today, okay, is going to be a function of real rates, all that sort of stuff. Okay, but in the future, okay, we can either have a high price, so I'm going to put the price, and then I'm going to put sub H for high. That's not a very good H, but that's what it is. Okay, and then the price could also be low, right? So the price could be high or the price could be low, and we could assign some probabilities to that and get an expected price today, right? So, or the price today would be an expectation of what's going on in the future, would be a better way to think of that. So the expected price at time 1 divided by 1 plus R, okay, that's going to be the price at time 0. Right? Again, the handwriting there is bad. I'll clean it up from here on. Okay, so anyway, well, what does that mean? Well, that means that, yeah, we can get an expectation. So we have an expected value at time 1. If this were the binomial interest rate model, that's not when I'm not just varying interest rates here, but if they're binomial interest rate model, I'd find the expected value by taking 0.5 times the high value plus 0.5 times the low value, right? Okay, well, when is the value of the bond going to be high? Well, it's going to be high in good states of the world, right? So the economy's raging, everybody's getting rich, everyone's got a job. We go to parties that last all night, that sort of thing. And down here, if the value of the bond is low, it's going to be because of bad states of the world. That is, the company is stressed hard to make payroll, those types of things, right? Well, when the economy is good, okay, well, this is also when I, as an investor, think, my income is going to be high, right? So I have lots of income here in the high states of the world, and in the bad states of the world, if I'm not a counter-cyclical person, right, then I would have my income be low. All right, well, when income is high, okay, how do I value consumption in the future when I'm going to sell this bond? Well, in the future, again, I'm going to use my denominator of 10 in both cases. Okay, well, so the price of the bond is high, but that's because the economy's raging. Everything's good, so that marginal unit of consumption is only going to have 7 utils of value to me from my utilometer in this good state of the world. But in the bad state of the world, I'm really going to need that. Okay, so I need to be able to consume there because there's a time of relative scarcity. So in a bad time, this may be, consumption in the future may be 9, right? And again, you really have to move numerator and denominator, but we're just worried about magnitudes here. So what's happened? Okay, when the price of the bond here is high, right, then my marginal rate of substitution is low, right? And when the price of the bond is low, right, my marginal rate of substitution is high. And the point is, look, when one's high, the other's low. When one's low, the other's high. We have negative covariance between the value of the bond in the future and the marginal rate of substitution. All right? So we have negative covariance between the value of the bond at time 1 and the marginal rate of substitution at time 1. So we can think of the price today as something that's observable. That's going to be a function of the expected value in the future. So that expectation is going to be, you think of it 50% times high plus 50% times low, discounted at the real rate. So I'm just going to say that that's going to be 0.9, right? And then this covariance. But remember, the covariance is going to be plus a negative number, right? So I'm just going to put 0.05, right? So plus a minus 0.05, so the value of the bond today then is going to be 0.85, right? So this is a risk premium. So to the extent that we're worried about fluctuations in the value, fluctuations in the economy, we're going to see that for the risk-averse investor, the covariance between the future price of the bond and the intertemporal rate of substitution is going to be negative. And that's to say that when prices are higher, the utility of consumption at that point is going to be relatively low. Prices are high because everything's good. I don't need another unit of consumption because I got lots of other sources from which to fund my consumption. So the notion here is that when we're looking at these bonds, we've got this pure effect, right? That is going to be just the real interest rate. Okay? And we also have a risk premium is what we're trying to build into this. All right? So this is really saying that the price of the bond today is a function of interest rates and a risk premium. Right? And we're going to come back to that in just a minute. All right? So short-term rates. So short-term rates, if GDP growth rates are forecast to be high. So let's see. Growth is going to be robust for the foreseeable future. Well, then what does that mean for you and me? Well, I'm a college professor, so I have very bond-like returns to my primary employment, so it really doesn't mean all that much to me. But to you, if you're working in the finance industry, then high GDP growth rates means that there's lots of investment going around. If you're in M&A, lots of deals going down, and whatever it happens to be, you're thinking, all right, incomes are going to be high in the future. So investors expect higher income in the future and hence prefer current consumption. Right? So current consumption is going to be valuable in a relative sense to consumption in the future. So the intertemporal rate of substitution is going to be low, right? And we're going to see that interest rates will be high. So remember, it's a choice of, is the numerator going to be 7 or 9, right? So that's what we're looking at. So if we're looking at really robust forecasts for the future, okay, well then we think, hey, I don't need to transfer consumption that I could currently finance into the future, because when the future gets here, I'm going to be rolling in it, right? So we're going to see that the marginal rate of substitution is going to be low, and the interest rate is essentially 1 over this marginal rate minus 1, right? So if the marginal rates are low, then interest rates are going to be high. On the other hand, if you go back to 2008 when everybody thought the world was going to end, okay, well then we would have seen the opposite. And in terms of evidence, you can look on any given day at what's going on in developing countries. What you'll see there is higher interest rates. Why? Because the people there are expecting high growth rates in income because they see lots of growth in the economy. Lots of jobs being created, wages increasing, so their current consumption looks valuable relative to future consumption. So also, in addition to just the idea of consumption increasing because of GDP, we can have robust GDP forecasts, or we can have discouraging GDP forecasts. Okay, there's also going to be an element that deals with the volatility of GDP growth. So interest rates are going to be higher if the expected volatility in GDP growth is going to be higher because of some option-like stuff. So anyway, if we get higher, like a risk premium, so we're going to see, we'll see interest rates being higher in that case, right? So short-term interest rates, again, if you expect future consumption to be something you're going to have a lot of, then you're going to value current consumption a lot relative to consuming in the future. So maybe a little more in line with what you've seen elsewhere. So if you have a degree in economics, then standard joke is, I hope your therapy's going well. But you've seen this in the curriculum in a couple of places. This is what we would call, this first line is what we would call domestic Fisher. So the real rates in the short run are going to be equal to, the nominal rates in the short run are going to be equal to the real rates plus inflation. So this says, look, if in the economy we have real rates of 3%, we have inflation of 2%, then we would expect to see 5% interest rates in the economy. Okay, well that's reasonably accurate. This is actually an approximation. It should be 1 plus the real rate times 1 plus the inflation rate. You see it written that way elsewhere. So you see it like 1 plus R, that's supposed to be a plus sign, times 1 plus the inflation rate. Not that it matters here, it's just that you see it this way in the curriculum, that's why I'm pointing it out. So it would be, 1.03 times 1.02, and what you get there is a cross product term, essentially is what you're picking up. But anyway, so this is a close enough approximation if you're talking about real rates in the single digits and inflation in the low single digits. All right, now what about interest rates in the long term? So this is short term, right? In the long term, well, we're going to have the real rate and the inflation rate, just like we've had previously. But in the long term, when we get past a week or a month or a year, then we also have uncertainty about inflation. So in the long run, we're going to expect the long-term rates to be equal to the real rate of interest plus the expected inflation plus a risk premium for inflation uncertainty. All right? So the assumption here in the short run is that we're good at predicting inflation over the next 30 days. We're not very good at predicting it over the next 30 years. Right? So this theta term is going to be our risk premium for inflation uncertainty, and of course that can change. I think right now I would say inflation uncertainty is high, right? At least in the U.S. Now, why long-term rates aren't any higher is a whole other story, but we do see variability in that through time. Okay, what about the Taylor rule here? And so the Taylor rule, remember, this is the notion of how the central bank should manage the economy, okay, interest rates in the economy. And what we have are two terms. So we have an inflation gap, okay, and we have an output gap. And think of that in terms of GDP growth. So if we have, inflation, our target inflation is equal to 2%, and we have our change in GDP, I'm going to use a Y, as 3%, right? Well, what happens if inflation is above 2%? So if actual inflation is equal to 4%, then the inflation gap is going to be 4 minus 2, so that's obviously going to be 2%. Well, that means inflation is high. How do you fight inflation if you're a central bank? Well, inflation is prices increasing. Okay, one of the ways prices increase is demand pulls them up. Part of demand is the ability to finance your purchases. So what you would want to do in this case is the central bank would want to increase interest rates, right? So because there is a positive inflation gap, right? So that is actual inflation minus the target inflation, we would expect to see rates be pulled up, all right? Okay, what about for output in the economy? And so I'm thinking GDP growth here again. So if the actual GDP growth was going to be equal to, we'll say, well, I'll just say 6% for a number for the moment, then we would have a positive output gap, right? So that would be 6 minus 3 is equal to 3%. Okay, well, if you have the economy growing at 6%, when you think what is sustainable is 3%, as a central banker, what you're worried about is the economy overheating, right? So what you're going to do to sort of take the top out of the euphoria associated with this is you're going to increase interest rates, right? So the point here is that interest rates are positively associated with both the inflation gap and the output gap. Now, you could write this the other way. You could write it, target minus actual, and the arrows would go the other way. So make sure you realize that it's the actual inflation minus the policy rate or policy inflation, okay, and then actual output relative to what we think is the sustainable long-run growth in output. And in the same vein, just to make sure that we have gone through and talked about it, okay, what if the output here was equal to 1%, right? Well, then we'd have 1 minus 3 is equal minus 2. Well, that's the economic definition of what? A recession. If you were growing at less than what potential GDP growth is, that's a recession. The way you would counter a recession if you're the central bank is to decrease rates, right? So we say when we look at these two gaps, inflation and output, okay, well, interest rates, okay, are positively related to the inflation gap and the output gap. So if the inflation gap gets bigger, you expect to see the central bank drive up interest rates. If the output gap gets bigger, the economy is really overheating, you would expect to see the central bank, I keep wanting to say the Fed, sorry. So the central bank increase interest rates in order to, again, sort of take the top out of the economy. Don't let things get too heated up, right? Okay, yield curve in the business cycle. So short-term rates are low during recessions. Okay, we could talk about The reasons for that, one is going to be Fed action, but also it's going to be a time of scarcity. So we're going to have that working for us. So we're going to have these low interest rates. And due to expectations of higher GDP growth and inflation in the future, as the economy expands, longer-term rates are going to be high. So probably the way to rely on, the intuition you can rely on here, okay, is that when we look at interest rates that are short-term, okay, so, this is term and this is rates. Well, rates are going to be low during the recession for a couple of reasons. Okay, and the scarcity here really applies to investment opportunity. But nonetheless, when we're looking at very short-term rates, I'll put an S. Well, we would expect to see the rates that are low. But then when we look into the future, we think, wow, there's going to be lots of opportunity, right? I mean, the economy cycles, interest rates cycle too. So we would expect to see interest rates high in the future because relative to the dismal conditions we're living in today in this recession, and I say that as a function of the graph, not as what's happening in the real world. Okay, so we would expect to see better conditions in the future. Incomes are going to be higher, and that's going to lead to higher interest rates in the future, right? So anyway, just like we had talked about before in terms of changes in expectations of earnings and that sort of stuff. So short-term rates are going to be low during recessions, and due to the expectations of higher GDP growth and perhaps inflation as we come out of the recession, long-term rates are going to be high. So the punchline to this is we would expect to see a positively sloped yield curve during the recession. So the yield curve, again, time against yield to maturity would be one way to write it. We would expect to see that be upward sloping. And then for reasons that have economic description, just like we have here, we would expect to see that if we had an inverted yield curve, right, so time against yield to maturity for bonds, looking like that, well, we would expect to see that associated with potential economic slowdowns in the future. So late stages of an expansion, okay, we would see the yield curve maybe not actually invert, but certainly flatten out would be one way to think about it. So yield curves in the business cycle, well, the idea of, when things look rosy, we're going to see upward sloping yield curves. When things look dismal, we're likely to see downward sloping yield curves. Term structure, or term spread. So a term spread here is the yield on a longer term bond minus the yield on a shorter term bond. So this is the, holding everything else equal. So maybe it's easiest to do, well, it can't hold everything else equal, but everything else we can hold equal will hold equal. So this is the yield on a 30-year bond minus the yield on a 1-year bond, all right? So this is a nominal term spread is positive, okay, and attributable to a risk premium associated with inflation uncertainty, if we are looking at this in terms of risk-free bonds. So we have this, we have inflation. So if we're looking at a 10-year and a 30-year bond, both of those have inflation premiums built in. Okay, but we have this theta, which is the uncertainty in inflation, the risk of inflation, okay, which is correlated with maturity. The longer the maturity, the greater the risk, the inflation risk in holding those bonds. Okay, so we would expect to see that this term spread would get bigger because of this uncertainty in inflation as the longer term bond gets longer and longer. All right. So the break-even inflation rate. So here we're going to look at a break-even inflation rate. We're going to calculate it as the nominal yield on a default-free bond minus the real yield on a default-free bond. So the real yield, just think of this as our inflation-indexed bond again. Right? We're just trying to pull inflation out of the rate for this second bond. So you can think of this as a treasury bond minus a TIP, right? So TIPs are, treasury inflation protected securities. So they are default free, fill in your own downgrade joke, and they compensate for inflation. So what you're intended to earn there is a real yield, or what it's supposed to give you is a real yield. Well, if you buy the nominal bond, right? So the nominal bond is yielding 5, right? And the TIP is yielding 2. Well, the difference between them is 3, right? So the break-even interest rate is going to be the inflation plus the risk premium. So that is to say that this 3% is what you would have to, you're going to have to earn 3% more to cover this, or if you think the inflation plus the inflation risk premium is 3, well, then you can say, well, I can take my tips. I got to be earning at least 5 on my nominal bond. Otherwise, I'd be better off with the tip, right? So expected inflation and the risk premium for inflation uncertainty, that's going to be the difference between the two. Okay? And so you don't have either of those, inflation or inflation uncertainty, with the real return or the tip. So you've got to earn that on the nominal bond in order to be able to be as well off, to break even relative to the tip. Credit spreads on risky bonds. So we've seen this in a couple of other places in the curriculum, but this is the additional risk premium for credit risk, right? So up till now we've been talking about bonds that don't have default risk, don't have credit risk. Okay? They would have interest rate risk, but not credit risk. So now we're just going to be adding in this idea of a credit spread. So that would be like, we could calculate this as, the yield on a AA corporate minus a similar maturity treasury. That would be one way to calculate it. So credit spreads rise during economic downturns due to increased probability of default and lower recovery rates. So the economy is going to cycle down, right? When the economy cycles down, well, that means that, the world doesn't look as rosy. Employment is down, unemployment's up. GDP growth is way down or perhaps negative, okay? And defaults on bonds are going to be up, right? So if you look at a AA bond, right, then you're going to see, you can look at whatever its yield is and look at it relative to a treasury. Well, as the economy cycles up, okay, when the economy is cycling up, well, what happens at the top of the cycle? It's the peak, right? Everybody's got plenty of money to pay all their bills. So the spread between a AAA or AA and a treasury, or a single A and a AAA, is going to shrink. So credit spreads shrink during times of economic prosperity, right? So maybe look at it as, in good times, right, the spread might be equal to, 1.5%. Right? And that might be, we'll do it as AAA versus A. So the A might have a return of 5, and the AAA, it might have a return of 3.5, right? So A minus AAA is going to give us a spread of 1.5%. But then as the economy cycles down, and we're looking at bad times, well, then the A, or the AAA, to hold things constant, we'll say is 3.5%. But the A, and that would probably change too, but I'm just trying to focus on the spread, the A might go to, 6.5%, right? So now we're going to see the credit spread move to 3%. So credit spreads widen during bad times, right? So this is sometimes described as a flight to quality, right? So if you're a high quality issuer, then people want to own your bonds when everyone thinks that, the world's going to hell in a handbasket, Western civilization is going to cease to exist. Okay, well, that means that this spread is going to get wider. So if you think of the economy as cycling up and down, it's one of the earmarks of a capitalistic economy, right? So we're looking at, GDP here, or GDP growth, really. But if it goes like this, right? Well, when the economy's good, spreads are small, right? When the economy's bad, spreads are wide. Okay, well, if you think of going from a spread like this to a spread like this, it was a good economy, okay, and then it's a bad economy. Well, what happens to the value of a bond when interest rates increase? And the reason I wanted to hold my AAA constant here so we could talk about the interest rate increase and the spread increase as being the same. But remember, as interest rates go up, the value of the bond falls, right? So if you're invested in lower quality bonds when everything is great, and then you start coming down the recession cycle here, right? The economy starts to falter. Well, we would expect spreads to widen. Well, all yields could change, right? But we're talking about the difference between them here. So, all interest rates could go up or all interest rates could go down, but we're talking about the spread. Well, low quality bonds are going to underperform. Okay, so when things are going to hell in a handbasket, that's not when you want to own low quality bonds. But what about when the spreads tighten? So if you're going from a spread, spread up here was 1.5, spread down here was 3. Well, as you start to go back up here to a spread of 1.5, well, that's when the low quality bonds, in my example, the AA or the A bond, okay, is going to tighten. The credit spread is going to tighten. Well, that means that we're going to see that the interest rates are going to go down, so they're going to go from 6.5 back down to 5. In my little example, interest rates go down, the value of the bond goes up. Right? So thinking through credit spreads, you got to think of what's going to happen to the spread over the economic cycle, and then you have to remember as spreads tighten, then we're going to see that be good for low-rated bonds. So when the spread narrows, okay, that's tightens, goes from 3 to 1.5. The low-rated bond is going to outperform the higher-rated bond. But when spreads widen, as you go down into the trough, just the opposite is going to happen. So what you want to do is you want to hold high-grade bonds when things are good, and then after they bottom out, you want to trade all your money in for low-grade bonds. Of course, knowing exactly when to do that is an extremely difficult undertaking. All right. What about company products and credit risk? So the difference in credit spreads among sectors is due to a couple of things. One, typical leverage. Some sectors are more highly levered than others, so that's great. More leverage is back to our argument about financial risk. Higher financial risk, you're going to see the credit spreads be bigger in those sectors and also potentially more volatile. But what they really want to focus on here is differences in the types of products that the companies produce. So some companies produce products that have very stable demand, a utility firm, right? Other companies produce products that have very cyclical demand. That would be fur coats, right? I don't know if anyone wears fur coats anymore. But anyway, if they do, that would be fur coats. So what you would see is that the more variable the underlying cash generation process of the firm or the firms in the sector or the firms in the industry, okay, well, that's going to lead to wider credit spreads. Why? Because you're more subject to the cyclical nature of the bonds as they relate to the economy. So spreads for issuers in consumer cyclicals rise during downturns relative to consumer non-cyclicals. So we talked about utilities. Well, if you looked at different credit quality utilities, as you go down, well, there's going to be a change in the spread, right? The spread's going to go from 1% to 1.5%. But if you looked at the fur coat sector, which isn't really a sector, but as an example, then what you would see is that in that sector, we'd probably have wider spreads to begin with, but those spreads would really get big as we went down in the economic cycle, right? So the spreads of issuers in cyclical firms are going to increase relative to the spreads of firms in non-cyclicals as the economy goes down, right? So, and again, just economic logic. All right, business cycle and corporate earnings. This slide basically says cyclical companies are cyclical and non-cyclical companies are non-cyclical, right? So anyway, so the earnings of companies in cyclical industries, that is, consumer discretionary, luxury good type stuff, tend to be more sensitive to the business cycle. Earnings of companies in defensive industries, not the defense industry, defensive industries, although defense is probably a non-cyclical, maybe even a counter-cyclical, but earnings of companies in defensive industries tend to be relatively stable, right? So that would be, consumer staples. You got to buy flour, sugar, wheat, utilities, that type of stuff. So consumer non-discretionary, consumer staple type stuff tends to be more stable, less cyclical, and you would expect less impact on the credit spreads in the defensive industries than you would from bonds issued in cyclical industries, is what this is getting at. All right? The equity risk premium. So the equity risk premium, this is fairly straightforward. So equity is more risky than debt, and hence has an additional risk premium. So if you're going to take on more risk, then you've got to be rewarded for it. Corporate earnings and equity prices tend to rise during economic expansion. So if you think back to 2007-8, well, as we went into the financial crisis, equity values fell, right? So corporate earnings fell, equity prices fell, all that sort of stuff. And then as we came out, okay, then we saw earnings increase and we saw equity prices increase. Equity provides a poor hedge against bad consumption outcomes, okay? And this is something that you want to make sure and have a handle on. We're going to relate this, we're going to see that the story is also true when we get to real estate, commercial real estate. The reason here is poor consumption, the poor consumption hedging qualities, which is this bullet point that I've outlined. I'm going to come back to in just a second. Those poor consumption hedging properties of equity cause the equity risk premium to be positive, and I would argue bigger, all right? So once again, you've got to think of what's going on with the economy and what's going on with your portfolio. So the economy is going to cycle, right? So I'm not going to put a not going to put labels on the graph, but the economy cycles up and the economy cycles down. Okay, well, you know, what's happening here? Okay, well, this is where life looks a lot like a party, right? You know, you've got a job and you're making lots of money and all that sort of stuff. Okay, and also you look like a genius in your equity portfolio because your prices of your equity portfolio or in your equity portfolio are high, right? So at the same time you're making lots of money and getting big bonus checks, you're also got high equity prices in your portfolio. But then when things get bad, okay, well, this is where you're crying, okay, where, you know, you see you're not making money, right? So the only money you get is from an unemployment check, and the prices in your equity portfolio are going to be low, all right? So your income here, which I'm going to put as a dollar sign because I put it over here as a dollar sign, are going to be low, right? So what happens? Well, just when your income is low, your financial assets are also low in value. Okay, if your income is high, maybe I ought to make it consistent. Your income is high, then your financial value. Well, you don't need this to be high when your income is high, right? So that's why people save for retirement. When you're making money, you save for retirement, and then when you're not making money, when your income's lower, then you have your financial portfolio. But the correlation between the economy and equity prices means that equities don't help you hedge against bad consumption outcomes. So here you're consuming a lot. Here you don't have money to consume. You'd like to rely on your financial portfolio, but you can't, right? Why? Because the prices are low at that point in time. So equity provides a poor hedge against bad consumption outcomes. That is bad states of the economy. So the fact that you can't use it to hedge means that the equity risk premium has to be positive, right? You've got to be compensated for buying these securities that have exactly the opposite trend of what you would like to see, all right? Business cycles and price multiples. I don't think this is going to be anything too surprising, but price multiples, think price to earnings ratios, are positively related to earnings growth, right? So high earnings growth, and negatively related to all the things that would go into a discount rate, real rate, expected inflation, equity risk premium. So if you have high growth, then you're going to see a high PE. Okay? If you see high real rates in the economy, then that's going to drive PEs down. So you can think of this as, you know, from the equity section, price to earnings was equal to the dividend payout, right? I'm going to go to the next slide because that's messed that up. So price to earnings ratio is equal to the payout ratio divided by R minus G, right? Well, if G gets big, okay, well, that's going to make, this is going to be big as well, right? So positively related to growth. Okay, what about this? Well, this is going to be, you know, it's going to be the real rate, R, and it's going to be inflation, and it's going to be maybe some other things, but there's also going to be the equity risk premium, ERP, equity risk premium. Well, if any of these things increases, then R is going to get bigger. If R gets bigger, then the PE ratio is going to fall. All right? So a little bit of harkening back to our equity material here. Okay, but nonetheless, anything that increases required return is going to drive down PE ratios. Anything that increases growth rates, okay, is going to be good for PE ratios. It's going to make PE ratios go up. So they tend to rise during economic expansions, okay, and because the equity risk premium declines during these economic expansions. Now there's a way potentially to get around it. Shiller's real cyclically adjusted PE ratio, that's the CAPE, cyclically adjusted PE ratio. You can use inflation-adjusted prices, so, and a 10-year moving average of real earnings to reduce the volatility of the PE multiple. But that takes a long history of data to calculate the PE, so you probably want to think of that in terms of a very long-term portfolio as well, although that last couple of sentences is Andy and not necessarily the curriculum, so probably shouldn't have even said it. Anyway, so, but you can try to back out some of these impacts if you really want to try to do so, and this would be one example of how it gets done. All right? Business cycle and style. So growth stocks are characterized by, you know, high price multiples. That's the biggest single earmark, but also low dividend yields and frequently immature markets, meaning that there's still lots of growth to be exploited is what we mean by immature there. Value stocks are characterized by low PEs, generally high dividend yields, and mature markets. So what they're talking about is the value versus growth debate here. So do you want to have a value portfolio or do you want to have a growth portfolio? Well, it depends on where you are in the economic cycle. So value strategies perform well during recessions, right? So as you're going into the recession, you want to hold value stocks because they're going to get killed but they're going to get killed less than growth stocks would. Okay? And the growth strategy is going to perform well during expansion. So once everything finally bottoms out, okay, well, if you, to the extent that you're nimble and you can determine when it's bottomed out, yes, there's blood in the streets, but it's ankle deep. Is it going to get knee deep is the question you have to ask yourself. But anyway, if you're smarter than everybody else, you can determine that it's bottomed out. Well, that's probably when you want to switch to a growth strategy. And this is a great bullet point. Another style strategy is based on company size. Okay, so you can look at market capitalization portfolio, big minus small type thing. Of course, knowing when to jump into big and in and out of big is a very difficult thing. Sector rotation. So there are time periods in which certain sectors outperform, right? So utilities outperform during economic declines, for instance. So if you understand the relationship between the business cycle and the performance of different sectors, that can inform your sector rotation strategy, although timing is key, and that's the difficult part. If it were as easy as saying, oh, well, here's what's going on with leading indicators, that means that we're going to funnel into these sectors, then everyone would do it. And of course, if everyone's doing it, then it's already built into prices and it would be of little value. So timing is key, and it is really important and really difficult to do. Real estate here, in terms of commercial real estate, we would have to add another risk premium for the lack of liquidity. So it could take years to get out of a big commercial real estate position. Real estate is sort of a hybrid asset, meaning that these real properties have long-term leases, which give them bond-like characteristics. So you get your rent every month or every quarter. That looks a little bit like a bond. And even though those cash flows don't change too much over the economic cycle, okay, the value of the property at the end of the lease does change a lot, right? So the fact that at the end of the lease we have this uncertainty in the value of the real estate, okay, that gives it equity-like characteristics. So when I say it's a hybrid, I mean sometimes some aspects of the real estate valuation look like bond elements, and some look like equity elements. Just like equities, well, we tend to assign, even though the cash flows are more or less constant, we assign lower values to real estate when we are in the trough of recession, higher values when we're in the peak. So that's the same thing that equities do, right? Equity prices go down when times are bad. Equity prices go up when times are good. Same with commercial real estate. And so this doesn't make for a very good consumption hedge either. So higher values during economic expansions means that you get an increase in your real estate portfolio when everything else was increasing too, so it probably wasn't as valuable to you in that state of the world. Okay, and finally here to wrap things up, I think the last 4, 5, or 6 topics that we went through were really just some intuition about how the business cycle impacts some variables, and I think if you get the first few things down, you're going to do fine. So this idea of the rate of intertemporal substitution, okay, and what that means for real rates and how they're related to one another. The risk premium for long-dated, risk-free bonds, this idea of the covariance of the bond with the marginal rate of substitution, that seems to me to be a really testable sort of thing, and they spend enough time on it that I'd make sure I had an understanding of what was going on there. The business cycle, as it relates to corporate earnings, price multiples, asset values, sector rotation, that's what we did over the last 4, 5, or 6 slides. And then consumption hedging properties of different assets, in particular, if we're looking at equities and commercial real estate, the fact that they are poor hedges against bad consumption outcomes makes for some interesting discussion. It could be an interesting question to put at the bottom of an item set on the exam. So not too bad. Mostly this is economic intuition in terms of let's define some variables, see how they apply, and tell some stories. But generally the stories are things that you can get on top of with just a little bit of thought.